The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2019 webinar series. Our 2019 monthly webinars will include client stories, your client stories, and how those stories can help you and other clients in this year and beyond. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the question box. We'll answer all questions at the end of the webinar. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter is constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. In 2013, he joined LLIS with his CFP and MBA and has been leading LLIS as president and CEO. Here to share all his knowledge on life insurance is Mark Maurer.
Thanks, Claudia, and happy September to everybody. We're off to a rolling, beautiful fall here in Tampa. It's 90 some odd degrees, and our low tonight is going to be a nice around 78. So fall is definitely here. I digress. It's Life Insurance Awareness Month. I know everybody's very excited about that, but it's a good time to talk about life insurance, talk about reasons and needs and uses of life insurance. And for some of you who are new to the profession, a lot of this is going to be new information. For some of you who have been around a while, then this is going to be a refresher. Hopefully, you'll see some things and go, oh, I never thought of it that way. So we're going to dive right in because I can talk about insurance for a long time, so I need to get started. So we're going to talk about a few things. One, term life insurance. And we're going to talk about layering. Again, you may have heard me talk about this for years, but for new people, this is something you may not be familiar with. For regular attendees and advisors who work with us, it may be a great refresher. Similar with business life insurance planning. We're going to touch on Pension Max. And just in case any of you have to leave midway through to pick up kids or, get the dog out, if you retain one thing about the Pension Max section of this, is that in order to do it, we need some time before the person is going to elect the pension. Because once they elect a life only or life and 100% survivor, you can't undo that. You can't go back 3 weeks and say, oh, never mind, give me something different. So Pension Max, we need about 4 to 6 months because we need to get policies sent to the insurance company. They need to be underwritten. So, if the client has 1 month, we don't have enough time. 1 month before their retirement, before they have to make the election, it's not enough time. 4 to 6 months is the sweet spot. And we're going to talk about legacy planning. So we're going to touch sort of lots of clients, term insurance and layering, and then your business owners, retirees, and then people who want to make sure that they leave a legacy to someone. So let's jump right into term insurance. So I know you all have financial planning software. It's going to tell you, probably to the penny, it may round to $10, but probably to at least the dollar, how much life insurance someone should have given their income, their other assets, but we still get asked this question a lot. And so I'm not going to go into necessarily the calculation amount, but just overall, how much life insurance should a client have? When they're single, I'd say little to none. We have life insurance because someone has a loss at our death. When I was single, living with my college roommate, I think my largest asset was maybe the couch we shared, and we bought at a used furniture store. If something were to happen to me, no one was reliant on my income. I had no debts. I had no properties. So need is little to none. For a single person, no dependents, no significant debts or anything like that, little to none. And you'd be surprised, or maybe you wouldn't, how many times you have clients or other advisors send me policies to review for single people with no foreseeable need for life insurance who have $750,000 of whole life that they're paying $5,000 or $6,000 a year on. Single people, little to no life insurance need. Drop of water. Dual income, no kids. Okay, that was me and my wife for a little bit of time. Seems like a very long time ago, but we both had jobs. We had an apartment, maybe a little bit of life insurance need there. With the apartment, we really didn't have much. Then we moved on, we bought a house, so now there's a mortgage. Okay, so now there's some debt that we've taken on that it would be nice that if I were to pass away, my wife would have been able to pay off, but she had her own income. And so at that point, it's nice to have, good to get a base going, but again, little at that point, not necessarily a huge need. If something were to happen to me, my wife would have just probably kept working, paid off the mortgage eventually, so little to no need. Or much smaller need than for a single person. Larger need than for a single person, but still not a huge need. Now, once you have kids, now we open the floodgates. So instead of just a drop of water or just a little trickle on the hose that you forgot to turn off last night, now somebody's cracked open the fire hydrant and it's just gushing out. Because now there are small individuals that are relying on us and our ability to earn income and take care of them for at least the next 18 years or longer. My kids are still small, so I still use the 18 and everybody laughs when I do that. But at least for 18 years, they're 100% dependent on us as parents to care for them, go to work, earn income, save for college. So how much do we need? Once we have kids, then I think that's when the whole dynamic shifts, and that's now a large need. So the planning software is going to tell you the dollar amounts, but this is more how much should I have? Should I have any? Do I really need any? And again, how much should I have? Financial planning software is going to tell you. But sometimes we want to have a rule of thumb. We want to have something in the back of our head that says, is it reasonable? Well, insurance companies for term insurance are using it generally for income replacement. So it kind of makes sense that the rules are going to be number of years till retirement times income. So for someone in their 20s or 30s, insurance companies, a lot of them look at 30, some will go to 40 times income. And again, that's probably for your 20s. If you can imagine working, calling it age 65, we're good. And it makes sense. As you get older, the expected number of years you have decreases. So the amount of life insurance that you'd be able to qualify for income replacement without any extraordinary documentation like third-party financials, things like that, information about a special needs child or some of those things. This is just the run-of-the-mill. How much? I make $100,000. I'm 45. I could probably get $2 million of life insurance just by, and that's as simple as that. How long do we need it? Again, by the time I hit retirement, Social Security retirement age, it will probably start at 82 or 87, 96. Who knows? But I still think of retirement age as 65. So we start looking at using life insurance, making sure it gets me to retirement age, which is about age 65. Or asking the question a different way, when do you think you'll be financially independent? Because whenever I ask clients, when are you going to retire? Sometimes I'll get the answer, I never plan on retiring. I like what I do, so I might cut back and I might do something else or consult instead of work every day, but I don't think I'll ever retire. So then I've got to go back and say, okay, what's the financially independent age? What age can you say, I can pick and choose what I want to do because I don't need to go to the office anymore. I go because I like it. Again, we figure out we probably still use age 65 in our heads for a lot of that. So we're going to look at a couple. Here's Sean and Katie. They need $2 million of 30-year term insurance based on their incomes and based on the fact that they're 35. 35 plus 30 years gets them to age 65. Based on their incomes, $2 million of life insurance each. Nice round numbers here. Assuming they're both a preferred non-smoker, Sean's premium for that $2 million 30-year term policy, $1,755. Katie, $1,450 every year. So there's nothing, I mean, that's a great option. That's a great way to look at it. It's the right amount of insurance they need today, and the length of term and the time matches their time frame. But let's look at our income as sort of a decreasing number. And so sometimes I like to look at it as, if we look at it sort of the amortization of mortgage balance. I take out a mortgage today and I owe the bank $350,000. But as time goes on and I'm paying down the mortgage, my balance is decreasing. So it's not unlike that with income. They need $2 million today to replace the next 30 years of lost income potentially, but in 3 years, they have 3 years of income behind them. Do they still need $2 million in 3 years? Probably not. What about in 8 years, 12 years? Do they still need the full $2 million? Well, they have now 8 years of income behind them or 12 years of income behind them. So I think I kind of like thinking of it as the mortgage, the balance on a mortgage. As time goes on, here I'm paying down my mortgage. Same thing with life insurance and income behind me. And please feel free to type in questions along the way if you have any questions about what I'm doing or what I'm talking about. If there's something that I go through that doesn't make sense or somebody thinks is a good question that's particularly relevant at the moment, feel free to log in or type in and I'll see if I can answer there. So kind of like the amortization of a mortgage, life is kind of amortized out because we need a lot of life insurance right away when we have kids. Remember I said 18 plus years where someone is 100% dependent on us, our ability to earn an income, put food on the table, wipe food off the table, wipe food off their mouths, all those things. So the need is largest, I think, when we have kids, small kids. Then we still want to, at some point, they're going to be out of the house. Don't know when that is. Everybody may have their own different theories about when that's going to be, but at least at 18, they don't have to be anymore. So, but a lot of us want to make sure that our kids go to college, get a leg up in life. So we look at, there's some need that extends through the college age, but it's not quite as much as when they were 2 or 3. Well, time's gone by, and if they needed to get a job, they could. We don't want them to, we want them to go to college. And then we have sort of our third layer, which is retirement. So we hope that by the time we get through all 3 of these things, then we don't need the life insurance anymore. We don't need it for income replacement. So that's our goal. So we use the term layering because as time goes on and we earn our income, we use it to save for college. So every year that goes by, that income's earned and it does 1 year's worth of the financial planning that we needed to do with the income. And it saves for retirement. It pays down the mortgage. And as time goes on, the need for future income replacement through the life insurance decreases because there's fewer years of income ahead to replace. So, given all of that and all of my rationale on why the need for life insurance decreases over time, let's put that into life insurance policies. So for Sean and Katie, instead of that sort of flat $2 million 30-year term policy each for $1,755 for Sean and $1,450 for Katie, we're going to look at layering term insurance. So, going to stack a $100 million 20-year term policy on top of a $500,000 25-year term policy and on top of a $500,000 30-year term policy. What do we have? Well, for the first 20 years, they both each have $2 million of life insurance. All policies are in force. So for the first 20 years, while kids are smallest and there's the biggest loss if one of them was to die, we still have the $2 million of life insurance each. And then in 20 years, when they have 20 years of income behind them, the coverage starts dropping off. So for Sean, at a preferred 35-year-old male rate, the 3 policies sum $1,480 per year. So it's 16% less to do the term layer than a $2 million 30-year term policy, which is good, because if it didn't save the client's money, then it's just a little more complicated for no savings. So the good part is it saves 16% on the premiums, and it sort of tailors this policy to their specifics, their lives, which I think is just a neat thing to be able to do for clients. For Katie, her 3 policies would be $1,240, and so her initial annual premium is 14% less than a straight $2 million 30-year term policy, which is great. We like saving money. But a neat thing that we do is as the term policies drop off, they pay less over time. So you have one policy. He's paying the $1,755 for the first 20 years and paying the layer of $1,480 for the first 20 years. After 20 years, that first term layer policy drops off. With the 30-year term, he's still paying $1,755. With the layer, now he's only paying for the two policies, $935 per year. And the last 5 years, year 26 through 30, with the one policy, he'd still be paying $1,755. With the layer approach, now he's only paying for that $500,000 30-year term policy, so that's $505 a year. So over that 30-year time frame, the layering costs 30% less in just actual dollars over the 30-year single 30-year term policy. So again, I like the term layering idea. I think it's a neat thing. It's fun to do because you can save the clients premium dollars now and over time too. So what are the right layers? Well, sometimes this gets to be a little more art than science. My usual questions are, what's the client's income working with you? What's the client's income and how old are their kids? Because I usually start to look at a layer that maybe is 15 years, 20 years, depending on how old the kids are. I might do the first layer when we can get one of the kids to driving age. So that older child maybe can get other kids back and forth to school if one of the parents wasn't there. Then the second layer gets somebody out of college or into college. And then the third would then be the retirement age. I also like round numbers. Using a $500,000 policy generally is going to cost less than a $499,000 policy, because insurance companies price their policies at certain levels, $500,000, $1 million, so they're like break points in the investing world. So round numbers usually work a little bit better because of the banding right there, like I mentioned. Lots of little policies, a lot of times this doesn't work very well. So let's say someone really only needs $500,000 and we try to layer 10, 15, 20, 25, and 30 million-dollar policies. A lot of times you run into small bands, those lower bands under the $500,000 don't necessarily make it very efficient. lots of little policies, you also may run into multiple policy factors or policy fees. Policies many times will have a fixed $50 or $55 fee, whether it's a $100,000 term policy or a $4 million term policy for annual billing and things like that. So sometimes with lots of different layers, it doesn't always work out great. Usually be able to do some layering like that. Oh, I have some good comments here. Somebody says, I like the layering idea, but inflation over time tends to naturally reduce the purchasing power of both the death benefit and the premiums each year by the amount of inflation. And I agree. And so I would maybe counter with, but they probably still don't need $2 million in 29 years, because their income probably wouldn't be exactly, for 1 year, $2 million. So maybe you might look at this and go, well, I think maybe we don't want to reduce the layers that quickly. Maybe it's $500,000 of 20, 750 of 25, and 750 of 30. So it can still work, but maybe we don't, have the layers drop as quickly. So just something to think about there. When do you look at all the policies at the same time, so the client only has to go through one underwriting process? Most of the time, yes. And generally, that's a much easier process. Some insurance companies have even term layering designs where you can layer term riders on top of an additional policy, or multiple policies together only have one policy factor. Sometimes with underwriting, it's going to be much better to go with one company. Say the client choose tobacco, then Prudential and Cincinnati Life might be able to consider him or her, could be her or him, for non-smoker plus rates. And so at that point, then the underwriting potential class is going to overcome any other fees or factors by doing multiple companies at that time. So I hope that answered those questions. So another question, why does the layering cost less upfront for the same amount as the single policy? Good question. The most expensive year of a term policy is going to be the last year. So if I have $1 million 30-year term policy, the insurance company says, what's my greatest risk? That I have to pay $2 million in 30 years when Kyle is age 65. That's what they're essentially on the hook for. When we do the layering, the costs are less, because in my example, $1 million of it only goes to age 55. So $1 million 20-year term policy is going to cost less than $1 million 30. So that's how we're looking at that. Great question. All right, a few other questions that I might get back to, or we'll look at when we have time, because they're pretty long. I'll see what I could do, but they're good ones. We'll see how I'm doing on time. Okay, business life insurance planning. So for you, your largest asset may be your business. For a number of your clients, probably is their business. And on paper, it may not be a huge asset, may just have some desks and some computers, but it's the thing that's going to generate our incomes, your clients' incomes, for the next 10, 15, 20, 30 years. So it's an income producing asset, maybe a very large income producing asset, we hope. So why look at protecting it? Well, remember, we insure our boats, we insure our cars, we insure our houses. Those don't create income. I mean, unless you're renting them out, most of the time they just suck up income. You got to fix the boat. You got to keep the boat in the marina. You got to pay for that every month. The car, it takes gas and things break. The house, don't get me started on what things go wrong with the house and what it costs. So those things, we're putting money into them and we're covering them. Wouldn't we want to cover the thing that's actually creating income for us and creating income for our employees and making sure that their families are okay? Sounds like something we'd want to do. So only 1 in 5 business owners have key person life insurance. And so what is a key person? And I'm going to touch a little bit in a minute on buyout and how you protect it from, for being able to distribute parts of a business to other owners. But part of keeping a business running are the key people. They're critical to the livelihood of the business. They may or may not be the owner. Now, you may have key person life insurance on the owner. They may be the rainmaker or the person who has all the contacts. But there may also be other people who have specialized knowledge, specialized skills that you want to make sure that they're covered in case they were to pass away. That's maybe not necessarily losing an income stream, but creating a lot of expenses to try to replace what that person was doing. Likely responsible for management decisions, probably highly compensated, trying to get key man life insurance on people who make $8,000 a year part-time, where the business owners and executives aren't covered, probably isn't going to work. Have a significant impact on business income, so they're income generators, or using another example, they make the income of the business work efficiently. And there I'm talking about IT people, internal people. Special rapport with customers or creditors, specialized knowledge. Again, IT people who may understand your business and IT. You can hire lots of IT people, but it may take a year or two for them to understand how you do things. So that ability to know what you're doing and have those special skills is huge. So we look at a key person life insurance plan. It's ensuring the most valued asset of the business. It's the people. It's not the desks. It's not the computers. It's not the chairs. It's not the rug. It's the people. The people are what make a business, is what creates the income. And so if that person was to not be there tomorrow, then the life insurance is there to help the business keep going. Because the business owns the policy and the business is the beneficiary of the policy. And the business keeps going because it's going to use that money to recruit people, hire a headhunter, pay a signing bonus to recruit somebody away, to promote people from within. Again, there may be a loss of income for a while because the key person is no longer there, may take the others a little while to get up and running. So the life insurance helps with any lulls in income. Retain people. If there's 2 dentists and 1 dies, well, the office staff may start looking around and going, ooh, are we going to have jobs for a while because there's only 1 of them? Helps keep people around. Premiums aren't deductible, and this is usually going to be term. You can set it up as permanent coverage. You can use it to facilitate sort of golden handcuffs, or use it to provide cash values to pay something to the key employee if they make it to retirement age. But a lot of times this is just term. If the employee dies, the business gets the life insurance death benefit. And I said we'd talk about owners. 2013, 2014, almost 41,000 businesses closed due to an owner death. Now again, we're looking at it from our standpoint. Sure, I have my own life insurance, my family would be taken care of, but if I were to pass away tomorrow, what happens to the business? And the 6 people I employ there, or my 12 people in this business, their incomes are reliant on how the business works. So are there people there who could take it on but just might need some cash, or other owners who would say, we need to be able to buy out Mark's shares or Steve's shares, but we want to make sure that then we still have enough money to keep running the business. So I used Mowers as an example. I love how all of our heads fit on those bodies. It makes me laugh every time. But I used Mowers. So there's 3 of us. How we set up the buyout? Well, it depends on a couple things, but there's 2 main types. You have your entity purchase or stock redemption plan, or you have a cross purchase. And I'm going to give a little bit of idea of those. As it says down at the bottom, please contact a tax professional for any tax questions or advice. So I'm going to give an overview, and then please consult a tax professional for any tax questions or advice. Stock redemption. In stock redemption, the stock redemption buyout plan, the corporation is going to own the life insurance policies and be the beneficiary. Because what happens if an owner dies is that the corporation buys back the stock from that deceased partner's estate and redeems the shares. So it actually cancels those shares. So for in this case, 2 surviving owners, case being the pictures down there, for the 2 surviving owners, their basis is unchanged. They have a small basis, now they keep a small basis. But their ownership percentage increases. Say those 3 people owned a third, and a third. One dies. If you retire a third of the shares, now owner number 1 and owner number 3 had 33 and 33, but that other 33 is gone. Now how much do they have? They each have 50%. They each have half of the outstanding remaining shares. So their ownership percentage increased, their shares didn't necessarily increase, and their basis didn't change. A nice part about this is that I call it all corporate money. The premiums that are going out are just all in all of our different expenses. So it helps when you have older owners and younger owners, healthy owners and not healthy owners. It's just a big, sort of premium expense at a corporate level. And so that helps when, again, you have differences in ages and health. There's no tax to the employees. And a really nice thing is that there's 1 policy per owner. So the larger the business gets, the more owners you have. That's a really nice feature. Now, a cross purchase, you still have an agreement that says A agrees to sell to B and B agrees to sell to A if one of them dies. But the owners own the policies individually on each other. So I'd own the policy on my business partner would own the policy on me and pay the premiums out of pocket. What do we get from that? Well, from that we get that the insurance proceeds are paid tax-free. So if my partner dies, I'd get the life insurance income tax-free, which I'd use to buy out her shares. And then the shares that I purchase, I get a full increase of cost basis at that point. So I keep the cost basis in my 50%, her 50%, now I have 100% cost basis. So that's a nice benefit. And it works pretty well when we have 2 owners. You need 2 policies. So if we had, in either version, if we had 2 owners, we'd still need 2 policies. But if there are 3 owners, each owning a third and third and third, and we want to make sure that each person's taken care of appropriately, now you need 6 policies, because each person now would need to buy out half of the deceased partner shares. So if we each own 33% and one of them were to pass away, I need to be able to buy out half of his 50%. She needs to be able to buy out half of his 33%. So 16%. Lots of policies. 6 policies for 3 owners. If we have 6 owners, how many policies do we need? In an algebraic form, it's n times n minus 1. N being the number of owners, times N minus 1 because you don't need to buy a policy on yourself. 6 times 5 equals 30 policies. That administratively is not going to be a lot of fun. And then what happens if you add a 7th owner? So cross purchase works really well with 2 partners. It starts to get a little crazy when you have more than that. So just something to think about when you start setting up or having clients who ask you what is the best way to set this up. Number 3, pension max. So term insurance. We have a lot of people who are working, who are earning incomes. That's probably in almost every client sort of thing, unless they're retired. Business life insurance planning. A lot of people own businesses. It may not be 100% owner, but probably a lot of your clients are business owners. A lot of you are business owners. Now we're moving to pensions, which as time goes on, fewer and fewer people are going to have defined benefit plans. But people retiring today, a lot of them still have it. So we're going to talk about what pension max is. Because here's Kyle and Jenny. Kyle's about ready to retire, so they need to make a decision. The decision is what to take. He gets a spreadsheet when he's about to retire that says at your age, 56, when you retire in 6 months, here's all the different payout options based on what you've contributed, your years of service, etc. So the highest payment is going to be life only, and it's going to pay him for as long as he's alive, but no longer. So if he lives to 105, it's going to pay him the same amount. If he dies after 8 months, it's going to pay him the same amount and stop after 8 months. So because there's no guarantees or minimums, it has the highest payout, but your trade-off is that there's no certainty on how long it's going to keep going. Or the joint survivor, and usually it's called the 100% joint survivor, that says we'll pay the same amount whether Kyle and Jenny are alive, or just Kyle, or just Jenny. So if Kyle dies after those 8 months, then Jenny will continue to get that same amount of income for the rest of her life. So 100% joint survivor means that it's the same as long as both of them are alive. You may see something that says 50% joint survivor, and that would say we're going to pay one amount while they're both alive. If Kyle dies first, then we're going to reduce it by 50%, or or leave 50% of whatever the payment was. So, but the 100% means it stays the same. So those are the 2 options. There's a third option that we like to look at. It's called pension max. And the idea is, can Kyle take the larger amount, that higher life only amount, and then buy some life insurance to be able to replace the income stream that Jenny would need to basically create her own pension. So that's what we want to look at. Is there an option there? So the first thing, 2 questions. How much does Kyle need to make that happen? How much life insurance do we need on Kyle? And how much does it cost? Because the cost is going to determine whether this is a good idea or not. Well, first, how much life insurance do we need? This is where you all may have had people or clients or proposals where somebody says, we're going to do this, and assuming an 8% rate of return on the life insurance, then the clients are fine. They should have plenty of money. That wouldn't be how we do it. We're looking at what would a client need today to purchase an immediate annuity, so that has the guarantees, that isn't going to be subject to market volatility, or what would that take today? Because we're trying to do our closest apples to apples. The pension payment is guaranteed, or as close as it can be. The annuity payment is going to be guaranteed. So the immediate annuity includes mortality assumptions, short, long-term interest rates in there, and it's got guarantees, and it's not going to be overly aggressive. The more aggressive you make the earnings assumption on what somebody could earn on that life insurance, the more and more Pension Max is going to work. But it may not be an apples to apples comparison. So we look at it to say, okay, how much would Kyle need in a death benefit today to be able to buy Jenny, for Jenny to be able to purchase an immediate annuity to pay that same income stream for as long as she lives. Now, this need is going to decrease as Jenny ages, because at age 55, she may need 40 years of income. At age 85, though, she may only need 10. And this is for most pensions that are going to pay a fixed monthly amount every year or every month. So no cost of living or inflation increases. I'll touch on that later, but just assuming a straight same amount of income every month. So Kyle, about to retire. He can take life only of $11,796 or 100% joint survivor, which means it pays the same amount whether he's alive or not to Jenny, $10,044 a month. So the cost to cover the spouse, we have hidden life insurance there. She gets something at his death. So she gets something, it's money. So we'll call that life insurance. Cost to cover the spouse is $1,725 per month. On a net after tax 15%, $1,467. So $17,595 per year is the cost of the life insurance to be able to provide Jenny the same $1,044 if Kyle dies, predeceases her. So we use a single premium immediate annuity. Today would need almost $1.6 million in an immediate annuity to guarantee her $10,044 per month for her lifetime. In 15 years, it drops to 1.25. In 20 years, it's just south of $1 million. In 25 plus years, $740,000. So, come to the question. Can we buy life insurance to be able to have those death benefits at those points in time for less than the $17,595 per month, or $17,595 per year? Can he take the life only and pay less for the life insurance than taking the $10,044 per month? So assuming a super preferred rate, the life insurance to create that decreasing amount of life insurance is going to cost $18,950. But the pension cost was only $17,595. So in this case, Pension Max didn't look that great right away. Why did I look at this one? Well, this was the most recent one that I'd run. So, sometimes it works, sometimes it doesn't. I could always pick one that wins, where Pension Max works. But this was, I wanted to show a real life one, and this was the scenario we looked at. And in this case, it didn't work. Part of it is their pretty young age. And so you can see we don't get as much of a drop in that permanent coverage as if they were a few years older. Because here we still need about half of the amount of coverage in permanent insurance, and you can see that the permanent insurance is $12,000 a year for about the same amount of term, $6,000, $6,500. So a little slightly older, cost would have gone up a little bit, but been able to probably use a little bit more permanent coverage, and it may have worked. It may have just come out about even. So sometimes it's going to work. Sometimes the insurance cost is going to be $16,000 or $16,500. And we say, great, it works now and it works going forward. That works well. There's two other sort of side benefits to Pension Max, where sometimes, let's say it's about a wash. The cost of the pension was the $17,595, and the life insurance costs $17,600. Basically the same. There's a few other benefits to the Pension Max that may make it worthwhile. So let's say it is exactly even. There's no difference right away. With the pension max though, as those term policies decrease, kind of like with our term layer, the cost for the life insurance goes down. So we're kind of building in our own cost of living increases or adjustments as time goes on. The term policies drop off. They're paying less for the life insurance, but keeping the same amount of pension income. So their net spending is going up at those points in time. So again, assuming that the costs were perfectly even, or even in this case, costs more in the first 15 years. There's no particular savings. But in years 16 and 20, one of those term policies drops off. So compared to the joint survivor option, they're paying a little bit less for the life insurance than what they're getting each month. Years 21 to 25, $2,200 less in insurance expenditure, so they're keeping $2,274 more. At the end of all the term policies being gone, they're collecting the $11,000 per month and paying about $1,000 a month. So about $5,500 better after a number of years. This is a long-term, long horizon view of this. But in a scenario where it might be even, in a scenario where it might work better today, that's just another benefit of the pension max idea. There's another side benefit, is the pop-up option. So what does that mean? Well, once Kyle picks the payment, you're locked in. So we're all the reason we do the pension max is we're worried about what if Kyle predeceases Jenny? What if Jenny predeceases Kyle? If they'd done the pension max idea, Kyle would have elected the most pension income. If she predeceases him, he can just cancel all of the life insurance. Doesn't need it anymore potentially. So his income is $11,796. If she passes away in the next 3 years, let's say, and they elected the joint survivor, he's stuck at the $10,044. So the pop-up option helps with what if the spouse predeceases the pensioner. This is also a good option. Let's say that Jenny wasn't in very good health, and we don't necessarily need or want to plan on what happens if she lives to 92, 95. You could do the life insurance, be able to do all that, and just assume that at some point you're going to cancel the life insurance. Or maybe you don't need the permanent coverage to go all the way to 120 or 121 and just some long-term term. So things there where if the person who's going to get the pension needs to be healthy to make this work. But if the spouse isn't healthy, it may make a lot of sense to do the pension max, because if the spouse predeceases the pensioner, then he can cancel all the, in this case, Kyle could cancel all the life insurance if, she's expected not to outlive him. So when does this work? Well, Kyle's got to be healthy. Need to be able to get the life insurance and have the cost for the life insurance be better than what the pension's going to pay out. It's got to be a non-smoker. Smoker rates are too expensive. And has 4 to 6 months before the election. If it's shorter than that, we don't have time to get everything underwritten safely. If it's longer than that, things can change. And Kyle probably doesn't want to pay the $1,000 or 17, whatever it is, 17,000 a year in life insurance until he's getting the hundreds of thousands of dollars in pension income. So too long, too far out, the numbers might change and they wouldn't want to put the insurance in place anyway. When should they take the joint pension option? The retiree is a smoker or unhealthy. Most government-sponsored plans, because they may not be based on sound actuarial science. If they're wrong in their assumptions, they can just raise taxes. And most government plans have increases. And so the pension max works because we can use the term that decreases over time. A lot of coverage right now, like term layer, decreases over time. When you have those increases, the amount of life insurance doesn't really decrease or hardly decreases, so you need a lot of permanent coverage. Costs more. Again, harping on this again, has to decide at the end of the week, or if the pension is less than $2,000 a month. This isn't a hard and fast rule, but if it's much lower, if it's smaller than that or about that much, you don't get, you get life insurance policies that are only $75,000 or $90,000, and those are pretty inefficient life insurance policies. And so the last thing I want to touch on was leaving a legacy. I read an article, talked to a few advisors about this, and it has to do with the Secure Act. And it's got some passed, I think, in some areas of the law or legislature, but hasn't gone to fruition yet. And so I may be talking about, you all may know some of these things better than I do. So it's my understanding of it at the mark level. But the big thing is that everybody's thinking stretch IRAs are going to change. And sort of the consensus is that it's going to get rid of stretch IRAs so that you can't stretch an IRA over a beneficiary's lifetime. Thank you, somebody. It's stuck in the Senate for now. So yes, thank you. But the consensus is something's going to happen at some point. Who knows what it's going to be, but it's got some momentum. So can't do the stretch IRA over the beneficiary's lifetime anymore. And it may be fixed at a 10-year payout for a non-spouse, and there's a few exceptions for hardships. But that's the general crux of it. So who's it not going to impact? Well, it's not going to impact small IRAs. Grandma wants to leave a $100,000 IRA to each of their 2 or 3 grandkids. What are the grandkids going to do? They're going to take that $33,000 and run. They're not going to stretch that to, $43 over their, or $200 a year over their 20 or 30 year life expectancies, even let alone a 10 years. They're not going to take the $3,300 over the next 10 years. They're going to cash it in. Who's it going to impact? Large IRAs. So people who are probably looking at estate planning anyway. These are the clients who may benefit from this are ones who have large IRAs. They're not great for estate tax. They're not great for estate planning to begin with. They're taxed when they're distributed. They're included in taxable estates, have to take distributions. Even if you do the stretch, you have to take it out. Can be left in a trust. You can create IRA trusts, but even then, still have to do some of the distributions and things like that. So the idea of some of the things I was reading was that life insurance helps people who have large IRAs be able to do some of the things that you can do now with some of the stretch IRA provisions, but go ahead and get them set up now with something that's already in existence. Life insurance, and particularly an ILIT, irrevocable life insurance trust. So how does this work? Clients with large IRAs start taking distributions in life. Take the distributions and net premiums go to life insurance premiums. Utilizing annual gifts. Could be more, and in my example, I'm just going to use annual gifts. Talks about the age 59 to 70 and a half sweet spot. Why is it a sweet spot? Well, RMDs aren't required yet, but it's after age 59 and a half when you'd have any penalties. Clients might be freshly retired, so they don't have any earned income. And at least from an insurance standpoint, you're probably healthier when you apply for life insurance at 61 or 62 than you are at 70 or 71. I'm going to look a little pricing on that too. Again, no earned income, still healthy. So here's Jocelyn and James. She's age 60, and she's going to be a preferred non-smoker for life insurance. James is 61, he's going to be standard. A little older, not as in good a health. They have 3 kids, Joan, Jimmy, and Jack. They've done well. They're already retired. They have assets, no debt. Done really well. Don't expect to access their IRA that they've saved in for living. They don't really want to, probably don't really even want to mess with it. They've earmarked it in their minds for their kids. Why? Well, it has beneficiary designations. You can leave it as a beneficiary. Maybe they've started to talk to you about, what to do with that. That's going to be kind of their default. Probably should look at IRA trusts and things like that, but for the time being, they look at it and say, I named my 3 kids as beneficiaries on this. If something happens, then my spouse gets it, and then when both of us are gone, the kids get it. It's got a beneficiary designation on it. I remember, I remember filling that out. So that's my estate plan. That's what I'm going to pass on to the kids. Don't really think that it's all going to be taxable to them and some of these things. So what's another way to look at this? I said, let's look at a second to die universal life policy. We're going to take $106,000 distributions for 10 years, which hopefully nets us about $90,000 in premiums, net after tax, for 10 years. And we're going to pay life insurance policy premiums, $90,000 for 10 years, annual gift times 2 parents times 3 kids, and get somewhere between $3.7 and $3.4 million. Remember, it's a $1.5 million IRA. We took money out, created a 3.4, 3.7 lifetime guaranteed death benefit. That's tax-free, by the way. And assuming no growth or no losses in the IRA, there's still $440,000 left. We didn't take it all. And now that they're 70, they're taking smaller RMDs on just the 440. So it works it's kind of neat. It does a couple things. It gets a larger inheritance. Start using some of that money now. Smaller IRA left over, smaller RMDs, smaller taxable event to the kids later on. So why not wait till age 79 to 70 and a half? Well, because look at the premiums now. The same 10 years, we've used up all of the current IRA value, and that almost all of it, or in some cases more, because that's the net after tax number. Now, sure, the IRA may have grown, but still taking that money out is going to deplete basically all of the IRA. Should the client own the policy themselves or set up an ILIT, irrevocable life insurance trust? The plus to the trust is that it's separate from the insured for estate taxes. You set up the trust is the owner and beneficiary of the policy. The trust grantors pay the premiums into the trust. The attorney, the trustee, sends out the crummy letters, and then the trustee pays the life insurance premium payments to the insurance company. At death, the death benefit is not included in their taxable estate. It's estate tax-free and income tax-free. The money was gifted out of the estate, the premiums were, so that life insurance, the 3.7 or 3.4 is estate and income tax-free to the beneficiaries. The trust is the beneficiary, so the death benefit is paid right into the trust account, and the trustee disperses the life insurance proceeds to the beneficiaries through the trust provisions. This is another thing that with the IRA trust, you can create how you want money to be distributed. If you just leave the kids the IRA through a beneficiary designation, you don't necessarily get a say-so. You can't necessarily mandate that it's going to be stretched. So if I own the policy myself, I don't set up an ILIT. Well, the proceeds still pass income tax-free to the beneficiaries. I have the ability to change the beneficiaries, but assuming they're my 3 kids, I probably won't. And the death benefit is included in my taxable estate. Depends on if they're going to have a taxable estate now, after this next upcoming election, after the election after that, who knows? So that's another reason we don't know that part. But with an ILIT, the life insurance trust, James and Jocelyn can control from beyond the grave. It helps protect spendthrift children, helps protect minor children who can't inherit money. James and Jocelyn might be type A's and they really want to say, here's how everybody gets the money. You get $5,000 a month for the first 10 years, and then after that you get a distribution, then after that you get enough to buy a car, do all kinds of things. The ILIT, the death benefit's removed from the taxable estate. That's why we still think about it a lot. But what are some of the downsides? Attorney fees for setting it up, and those crummy letters every year. Is it a good trustee? Trustee probably shouldn't be older than you. Definitely shouldn't be older than your parents. And once it's gifted, it's gone. There's a loss of some control. So many times I threw out the idea of what we call the poor man's islet. The children apply for the policy on the parents. So the parents gift the premiums to the adult children. The kids are the owners and beneficiaries of the policies. So by doing that, the premiums are gifted out of the estate. And because the kids own the policy from day one, the death benefit was never in the parents' estate. So it's estate tax-free, death benefit passes income tax-free, you're still doing the annual gifts, basically getting to do all the same things, but without a trustee and without a trust, which can be a good or bad thing. Because remember, once you give it away, it's gone. If the kids own the policy, then they can change the beneficiary from themselves to that good-for-nothing boyfriend that you never liked. Or you can gift them the premiums this year and they don't have to pay the life insurance premiums. But you know what happens? You don't have to gift it next year if they don't do what you want to do. So there's still some control there. So we covered a lot of things. It's Life Insurance Awareness Month, so lots of ways. I hope I made you aware about ways to use life insurance. Term and term layering, business life insurance, pension max. Please remember, 4 to 6 months. Need 4 to 6 months. And legacy planning. We have 2 more conferences this year that our LLIS team members are going to be at, the NAPFA Fall Conference and the ACP Conference in San Diego. That's, wow, it's already next month. So it's coming up pretty fast. For those of you who are new to LLIS, we put together this David Letterman, and as I realize the older I get, the fewer and fewer people remember David Letterman. But top 10 things, so top 10 things that make LLIS different. One of them you just did, our CFPCEs webinars, and we have 3 more coming up through the course of the year. And I'm doing the next one in October, Insurance Writers to Consider. Remember that we are not your competition. As fee-only advisors, we work with you. Our only clients are fee-only advisors. And we work hard to save you time and your clients money by doing things like term layering, by doing a lot of pre-underwriting. And we have lots of tools that I hope are helpful to you and your clients on our website. We are proud sponsors of a number of different fee-only financial planning groups. And as you saw, two more conferences we'll be attending at the end of the year. We have specialists in life insurance, disability insurance, long-term care, annuities, and the hybrid life and annuity policies with long-term care benefits. And we help manage your clients' policies for you and with you with our advanced premium emails to let clients know that a premium is coming up so it doesn't get lost in the mail. And notice of term expiration. When clients have that 10 or 15 or 20-year term policy, it's good to know that it's coming up to the end of that 10 or 15 or 20-year term time frame. And do they need different coverage? Do we need to do something different? And then we have Alice, so our online advisor portal. So lots of information there that you can see on your clients' policies, quotes, statuses, updates, all of that. So I asked for questions. There were some good ones along the way. And I have here still 2. I think one of these I may have already answered. If you're looking at a term layer, do you generally try to place with the same company? Is there significant savings on underwriting? Does it not matter? So I kind of touched on that, but yes, sometimes, so from an underwriting standpoint, the insurance company's indifferent if it's $1 million 30-year term policy or $333,000 layers. So from an underwriting standpoint, it's not necessarily that big of a deal. I think administratively and application-wise, it's really helpful if we can use the same company. And for the most part, when it comes to underwriting, it probably will. Like I mentioned with the non-smoker rates with Prudential and Cincinnati Life for someone who chews tobacco, it probably just works itself out organically that one of those 2 is going to be best for the term layer, so just would use the same insurance company for that. And trying to apply for 3 different policies with 3 different applications for your clients, it's much nicer when it's one set of paperwork. And the last question, we do a financial plan to solve for insurance needs. It's basically a cash flow where we kill off a client or spouse a day. Other than the rule of thumb that you presented, are there other approaches? That's a great question, because you have all of that information about the clients. You have a lot more than we do. So if you're using that and that's where you're coming up with your numbers, I think that's great. My rule of thumb isn't going to negate any of that. The rule of thumb is sort of there to say, okay, I ran these numbers and they make $80,000 a year. It's telling me they need $15 million of life insurance. In my head, so like I said, that rule of thumb is just somewhere between, they're 35, somewhere between 20 and 30 times income is where that number should be. So at least as far as approaches, you know, I tend to use a multiple of income for for myself. And you know, if someone asks me the questions, what's a good amount? Because I figure everything we do financially should be based on our income. It would be nice if somebody making $25,000 a year could afford to put all 7 of their kids through Harvard. You're just not going to be able to do that on the income. So what your financial plans are going to be are based a lot more on your income than any sort of potentially, sometimes they call it a needs analysis, but a cash flow analysis is probably going to work on very similar to the same thing as sort of an income replacement factor. All right, no more questions. Thank you, everybody. I really appreciate it. I will see you in October, probably a different bat time, same bat time, same bat channel, might just be a different day of the month, but thank you all for attending, and I really appreciate it.